Yes, hello guys. Good morning, good afternoon, good evening, depending on where you are. My name is CPA Makan. Today I'm taking you through again revision on financial management sitting, that is August 2025. Kasnep. This is CPA. So today I'm taking you through that particular revision on financial management, August 2025. Secondly, I would like to request you that if you have not subscribed and you have actually been viewing my videos, kindly I request you to subscribe, share, and invite as many people as possible to come and enjoy my free revision. Thirdly, I request you, if you want to support my YouTube channel, kindly I request you to send any amount so that I'm able to to buy some equipment to improve my view and my video, so that I'm able to give clear and accurate video concerning the revision. So you can use the number 0735 346 777. Any amount is the best. So therefore you have no need to say I have little. No, just send any little amount of money and I will be able to use it to buy equipment. That's why I'm saying 0735 346 777. So therefore, welcome and enjoy the revision. Okay, let's begin from question 5. I want to begin from the end. Question 5D. So question 5D is about net asset valuation. That is the question is about net asset valuation. This is about the valuation of assets in an organization. And when we talk about the valuation of assets in an organization, we are talking about the ordinary shares or shares in the organization on the market value, plus any assets, plus any cash that is available, plus any other asset, minus any expenses, divided by any of the ordinary shares that are available. So in this case, we are now saying, for us to calculate this question, we need to say net asset value is given by market value of securities plus any cash that is available minus expenses. You divide everything here by the number of securities. Remember, when you talk about securities, you are just talking about any assets that are available for sale. And therefore, we need to get the value of those assets that are available for sale plus any cash that is available minus expenses. You get this answer. From this question, you have been told the Alliance Fund is a mutual fund that holds long-term positions in a small number of non-dividend paying stocks. The holdings at the end of the 2 recent years are as follows. So we have 2023 there and 2024. We have the number of shares and the price per share. Then we have also the number of shares and the price per share. So for us to find out this, our work will be very simple. We will just work out as it is on the formula. So for 2023, for me to get the value there, I will need to take, for example, we have A2, we have A as stock here, A to M, correct? So A to M, I have the figure like 20,000 there. Then I have the price here of 45.25. So when I multiply, I get now the market value, which can give me the figure to be around so therefore, when I multiply the number of shares times the market price, the figure I get is 905,000. Okay, then I do all the assets also right away from A to M. For the M1 there, I can see it is 0. There are no shares for that case. Then I multiply by 17.75. The answer I get there is 0. So when I add all what is available here, correct? When I add all, I will get now what we call the market value of securities. So the market value of the securities, if you work it carefully, is 14,709,324. Correct? Then we have now the cash available also from the question there. If you check the question there, you have again been given the cash as 708,400. Then we have been given the expenses, which is the last item there, is given as 144. Expenses 146,000. So work out like that. Then the net value is 15,271,724. Now, this is now the market value plus cash minus expenses. Then we want now to find out the number of securities. So for this case now, we need to find out the number of securities, that or the number of shares that you are seeing there. We take the shares for 2023 plus shares of 2024. So if you add the columns from A to M for the shares, the answer you get is 1086,000. So therefore, the question is saying the net asset value of a share, which means per share. So therefore, say net asset value for 2023 will be the total figure 15,271,724 divided by the number of shares, which is 1086. So when you divide it carefully, the answer you get there is 14.06. So that is for 2023. So we go to 2024. You need to ensure that your work is properly arranged, because arrangement of work also attracts and motivates the marker to give you good marks. So therefore for A, I can see the total shares there for A is still 20,000. For A is still 20,000 there. Okay. 20,000. Then market price or the price there, I can see there the price is 48.75. So when you multiply that figure, the answer you get is when you multiply that figure, you get again the figure there. Then you work out up to M. M there, I can see the M given there is 0 again. Multiply by 27.88, then you get 0. So when you add all for 2024, the answer you get is 17,305,402. Then we have the cash shown there. Cash shown there is 166,000, and we have expenses also shown there of, so this is 574,600. Expenses is 166,000. Okay, so when you work out that, you get the net value is 17,714,002, like that. Then now you need to calculate the net asset value for 2024. So you can now say net asset value for 2024 will be 17,714,002 divided by total assets of 1086,000, and the answer you get is 16.31. That is part Roman 1. Roman 2 was saying calculate the growth. So growth here, we take now the current year, which is 2024, minus 2023, you divide by 2023. So this gives you 2024 is 16.31 minus 14.06, you divide by 14.06. So the answer you get is around, the figure you are supposed to get there is 16%. So for that case, you would have now scored your 6 marks for question 5D. Okay, we move on. Question 5D. We go to question 5C. Question 5C. Question 5C is about replacement of assets. So in this case, the question is saying, Talino Development Limited is a manufacturer of bricks and concrete blocks. The company is considering replacing part of the current manual labor force by purchasing a small tractor with a forklift for use in loading bricks and concrete blocks. The purchase price of the tractor would be 6,500,000. The tractor will have an economic useful life of 5 years, but would require 250,000 overhaul cost at the end of the 3rd year. Then the tractor would be sold for 1,500,000. That is the selling price. Then the company is estimated that it will cost 2 million. So the company estimates that it will cost 2 million per year to operate the tractor. However, the company will save 1.5 million annually on labor cost. Due to increase in handling efficiency, losses caused by breakages will be cut by 2.5 million per year. Sales will also go up by 5 million per year. The increase in sales level is expected to be maintained throughout the tractor's useful life, which is 5 years. The firm's gross margin ratio is 40%. Corporate tax rate is 30%, and cost of capital is 12%. The firm provides for depreciation on a straight line basis. Required, compute the net asset, the net present value of the project, and advise on whether the tractor should be purchased. So in this case, we have to calculate one net present value, which is given by present value cash inflow minus present value cash outflow. Once we have done that, we come now and give the advice. Okay? This advice can either to reject or to purchase. So therefore, in this case now, I gave out specific stages that we are supposed to follow. Stage number 1 is to calculate initial investment. First is calculate initial investment. So the initial investment, I gave out specific outline on how to go about. The first part is get the purchase price of the new machine. In this case, we have been told it is 6,500,000. Then once you buy this particular machine, you need to install it. So we have what we call installation cost. When you buy the machine, you need now the installation cost. So in this question, we have not been given. So I'm adding that. I need to add that. Once you have done the installation cost, you need also the working capital. Remember, working capital is the difference between current assets and current liability. You need some cash to work out on this one. So we add working capital also. And remember, this working capital is always at the beginning or at the start. So in the question, if you come across a question that has working capital at the beginning, another working capital at the end, the working capital at the beginning will be part of the initial investment. Then we can now say less proceeds of old. Assuming that there was old machine that are being replaced. There was old machines that are being replaced. So if you are replacing that old machine, you are getting some money. So that money you are getting will reduce this money here. So we need to subtract that like that. And now the net book value, we have what we call the call it tax shield. Tax shield. That shield can either be an addition or a subtraction. Now, from this question here, we don't have any of these. So, our correct figure is 5,600,000. That is our first part. The question now, how do we calculate the tax shield? Tax shield. Remember, I'm just trying for revision purposes. So, tax shield here, you need to take the net book value of the old, net book value of old, okay, minus the purchase price. Not purchase price, but proceeds, sorry. Proceeds. Proceeds. Once you sell now, these proceeds that we have subtracted here, you subtract. Now, the answer you get here is exactly, I'm calling what? The answer you get here can either be a positive or a negative. So let me see. Now, if the figure here, if you say now net book value minus the proceeds, you get a positive here. It means what? It means that amount, that positive amount you have here, okay, this amount you have, this positive here, will automatically attract it's called a gain. So it can be called a gain. Or you can say a loss. So in this case now, let's see what is happening. If the net book value is more, for example, assume it is 20,000, and you are selling the proceeds at 18,000. So you can see there is a loss of what? 2,000. Are you seeing the loss of 2,000 class? So this loss of 2,000, because the proceeds is 18,000 and the net book value is 20, so we have sold it at a loss. This loss here is what they call what? A tax loss. You call a loss. And if you sell it now, for example, it is now we have sold it at 22,000. So there is a positive of 2,000. This one is called a gain. So this gain here, remember I'm saying a gain comes in when you take the proceeds minus what? Net book value. So we get the gain. That gain will attract extra tax. That extra tax is a cost you add here. Okay, sorry. Before that, once you get this figure, you now take 30% of maybe that 2,000 negative and 2,000 positive, whichever. So if it is a negative, it is called a tax loss, and it is an advantage to us here. It will be subtracted. So 30% of that. Then if it is a positive, it is a cash outflow. So it will be 30% of this we will need to add here. So once you take now 30% of that, that is the time now you come and put your figure there. You get it now? So it is very, very important. Once you have done this one, from this particular question, we have not been given much. You have just been told the second point was that there was 250,000 overhaul cost, which will incur on the third year. So which means that it will affect the revenue for the third year. In this case, it will go to the revenue on the third year. So we skip that one. Then we have also been told the company estimates that it will cost 2 million per year to operate the tractor. So operational cost will be 2 million per year, every year for 5 years. So it will affect our revenue for the year. Then, however, the company will save 1.5 million annually every year on labor cost. So that saving on cost will be like an income to us. So we'll add to our revenue. Then we have also been told there is a breakages also will cut down. Cut down means it will reduce by 2.5 million. So it will be another cash inflow. So we'll add to our revenue per year. Then sales will also go up by 5 million. So sales will go up by 5 million because of this new machine. Then thirdly is that the gross margin ratio is 40%. So the gross margin is 40%. So therefore we begin from there. So we now calculate the gross profit is 40% of 5 million. I'm getting here 2 million. This is per year, but for 5 years. Then we have now add safety cost. Add labor cost that has been saved. We have been told is 2 million. 2 million or 1,005,000. 1,500,000. We have again saved on breakages. 2,500,000. So when you add, you get 6 million. So that is our cash inflow that we have at the moment. So from here, and then we now say less expenses per year. In this case, we have operating what? Expenses, which we have been told per year it will be 2 million. So the answer we get is profit before depreciation and tax, which is 4 million. Correct? Once you do that, you now come and say depreciation. In this case, we have been told it will be 6,500,000 is the cost of what? The asset. Then you minus the salvage value of 1,500,000. That is the sale of that particular. You divide by 5 years. So when you work out this one, you get 1 million. 1 million. So your profit before tax is 3 million. Then you have been told tax, okay, is 30%, okay? That is saying 30% of this, you get 900,000, okay? Then profit after tax will be 2,100,000. Now, because this replacement value, we use the cash flow, not the profit, not the accounting profit. This one, profit after tax, is accounting profit. So we don't need the accounting profit, we need the cash flow. So which means we add back our depreciation. So you add back your depreciation. Add depreciation, which was 1 million there. So your cash flow is 3,100,000. This 3,100,000 is for how many? Every year for 5 years. So I have now my cash flow for 5 years. This is my cash flow for 5 years. So it means now, this for 5 years, I need to discount it into present value. So I can now say period here. This cash flow here, I will get it for 5 years, 1 to 5 years. I will be getting 3,100,000 per year. Okay? Then I need to get this is the cash flow. Then I need to get the present value interest factor at the rate of what? That are giving me the rate of 12% for n years. Then I need to get the present value. So this is accumulation, this is annuity. Because say 1 to 5 years, it will be the annuity here. Then another income came in, not another expense came in on the 3rd year, which we were told is overhaul cost. Overhaul cost was 250. Overhaul cost. How do we show the overhaul cost, class? It is an expense. We show it like that. But it will be on the 3rd year. Then we have an income on the 5th year, which was the disposal. This one here. This amount that we have received when we dispose them. When we sell this machine here for 5 years, we will get 1,500,000. So we will have also 1,500,000, which is a cash inflow. So from here, you are able now to get that answer. Now, remember this class, I said if it is annuity, we say 1 minus into 1 plus r power negative n, you divide by r. So in this case now, it will be substitute 1 minus 1.0.12 power negative 5. You divide everything by 0.12. What is your answer, class? So if you work out that question correctly, you are able to get something like 3.608. And for this one, it's just on that particular year. So in that particular year, so it means it will be 1 plus r power negative n. This is only that year of 3rd year, not accumulation. So this not annuity. So it will be 1.12 power negative n. It will be that like that. So let's see now. So if you work out this one, if you substitute this one, it will give you a figure like for 3 years you get 0.9 0.5674. Then for the fifth year, it's still the same, which is this one. So you just put 5 there like that. Then your answer you get there is so this one is 0.5674, but this one is 0.7118. So once you are through like that, then you want just multiply this times that, this times this, this times this. So if you multiply this one, your answer you get is 11,174,880. Then the other one is for 250, you get 177,950. It is negative. Then this one will give you 851,140. So if you add that, you get what you call present value of 11,848,070. This is what you call present value cash inflow. Then present value cash outflow is now our initial incremental here, which is 6,500,000. So if you subtract, you get the NPV of 5,348,070. So you are asked to calculate the NPV. I have it there. Advice. So we say that if NPV is positive, then we accept that particular project. So we accept the purchase of that particular element. So that is number 5C. We go to number 5B. We go to number 5B. Remember, I'm the very first person to do the questions for the last sitting from CASNEP syllabus, CASNEP questions. So these are very pure and it has never been done by anybody at this particular time. So I'm a very first person to do these questions and share with you immediately for evaluation. So I hope you will subscribe and share with your friends. Question 5 is very simple. It says 5B. In this case, we are working on B. It says, Mara Limited is a company quoted at the Security Exchange and is experiencing a period of rapid growth. Due to this rapid growth, a momentous growth of 15% per annum is anticipated during the next 5 years. So there is a growth of 15% for 5 years. Correct, that's what you have been told. Thereafter, a normal growth rate of 5%. Thereafter, we have another growth to infinity, 5% infinity. 5% to infinity. Then the shareholders of the company require a rate of return of 10%, that is R. So you can say R is 10% per annum. Then we have also been told from the same question that during the previous year, the company paid 4 shillings per share as dividend. Previous year. So is it D0 or D1? If it is a previous year, it is D0. So in this case, we have now the D0, which is 4 shillings, which has been paid. Advise an investor interested in Mara Limited on the maximum price to pay per share. Maximum price to pay per share. Therefore, in this case, for us to advise this particular case, you want to work out the present value of the information given. That present value of the information given will act as the market price, as the price to be paid by the investor. So let's see. In this case, the dividends are growing by 15% for 5 years. For 5 years, this 4 shillings here is growing by 15% for every year for 5 years. Then the sixth year, it will be growing by 5% to infinity. Correct? So it means it will be now a period here. 1, 2, 3, 4, 5. Then this from fifth and fifth, which means the beginning, the beginning of the sixth year here, it will be to infinity. Okay? It will be to infinity for that matter. So therefore our work will be very, very, very simple. Okay. So our work will be very, very, very simple. Okay. Now from here we can calculate now the dividends here. Okay. So because this one is for the previous year, what about the end of this year? It would have grown, right? So it will be 4 into 1 point, it's growing by 15%, right? Like that, power 1. Then again 4 into 1.15 power 2. Then this is 4 into 1.15 power 3. This is 4 into 1.15 power 4. And the last one is 4 into 1.15 power 5. You get the answer. So if you press your calculator very well, your answer you get here is 4.6. This is 5.29. This is 6.08. This is 7.00. And this is 8.05. From here, then we calculate the present one infinite. Remember, I said for this case, I gave out the formula. You just need to say the market value of that asset is given by D0 into 1 plus G over R minus G. Correct? Minus G. So when you do this now, this is this now the value for that particular dividend to infinity. It is growing, which means D0 will not be 5 at this particular, will not be 4 at this particular time. It will be at the end of year 4. So at the end of year 4, I have 8.05. So I will take now 8.05 into 1.05. So from year 6 onwards to infinity, it will be growing by 5%. So I divide by R. In this case, it is 0.1 minus 0.0. G growth rate is 5. So if you work out this question, it gives you 169. Correct? Remember, this 169 is at the beginning of the 6th year. Meaning, when we are discounting this figure of 169, it will be not at the end of the 6th year, but at the beginning of the 6th year. So therefore, our present value interest factor at the rate of 12% for n years, whatever that I have on the 6th year will be used to discount this figure here, because it is at the beginning of the 6th year, not at the end of the 6th year. So if it is at the beginning of the 6th year, it means these are balances brought forward from the 5th year. So let me see now. So if you press, because these years are following each other, it will be 1 plus R power negative n. Very important formula. So when you press it your calculator, you'll get 0.9091, 0.8264, 0.7513, 0.68030, then 0.6209. And this one will also be used here, 0.6209. So we have now the present value, which means now this times that all. Your answer you get here is 4.18. This is 4.37. This one is 4.57. This is 4.78. And this is 5.00. And this one will give you 104.96. So when you add all these, your answer you get is 127.86. So this is the market price that you can advise this advisor to pay. That is how that question was supposed to be handled. We go to question 4. Question 4. You go to question 4, class. So, question 4. So, question 4. Oh, sorry, this is question 3, sorry. The one I've just done was question 4, sorry. So, I go to question 3. So, our question 3 is very simple. You have been asked to calculate the ratios. So this question is from the ratios. So Roman 1, that is question 3C. Question 3C. So we have been asked to calculate inventory turnover time. Okay. Roman 1, calculate inventory turnover time. Class, I suspect students made a mistake here. They calculated inventory turnover ratio instead of turnover time. This is where the mistake came from. I suspect students did not get this question correctly. So they calculated inventory turnover ratio instead of what? Inventory turnover. Which means this examiner was tricking you to say this is called average inventory period. This one we look at average inventory period. You can see. So the examiners, the students actually calculated the ratio, inventory turnover ratio, by taking now the credit sales divided by, not the credit sales, but yes, credit sales divided by the average inventory instead of average inventory of credit sales times 306. So that is where the mistake here. So this one we shall now calculate by saying it is average inventory, correct, divided by cost of goods sold. Then you multiply by 365 what? Days. So that is our formula. So we need now to work out for the years, for the 2 years, that is 2020. We have been told 2024 and 2025. So you have 4 marks each. Students did not get the entire 4 marks because they calculated inventory turnover ratio instead of time. So most of the students did not get this question right. Now, we now come and say we have 2024 here. So average inventory from the question, I've been given the average. For 2024, we need to add inventory for 2023 plus inventory for 2024. You divide by 2. So we now work out on that and say average inventory will be, for this one will be 195,000 plus 195,000 plus 360,000. You divide this by 2. You get divide by cost of inventory. We have been given cost of inventory, additional information number 1, which is 1,680,000. So you multiply by 365 days. So your answer there, when you work out that question correctly, your answer you get there is 70 days. 60.33 days. So 2025, inventory for 2025, you take inventory for 2024 plus 2025. In this case, it will be 360,000 plus 337,500. You divide this by 2. You get the average. Divide by the cost of sales and additional information number 2, which is in this case is 1,800,000. Then you multiply by 365 days. So when you work out that question, the answer you get is 70.72 days. So you have your 4 marks. Roman 3, Roman 2 is average collection period. Average collection period. How do we get this, class? Average collection period. So average collection period is just take you just need to take very simple. You need to take your cost of sales, that is receivables, average receivables, accounts receivables, average collection period. So average collection period for that case, our work will be very simple. Average receivables divide by credit sales times 365 what? Days. So it's still for 2020 2024. So average collection period class, average sales. So if you look at this carefully, the average collection is given there already for 2023. So average for 2024, I need to get the average receivables. That is 2023 plus 2024. It is giving me 367,500 plus 2024, which is 468,000. Like that. You divide this by 2. You divide everything by credit sales given there, which is additional information number 1 of 2,250,000. Then multiply by 365 days. So your answer there, when you work out that question, your answer is 67.77 days. Then you go to 2024. 2024, I can see there as 468,000 plus 2025 of 600,000. Then you divide this by 2. Everything over 2,295,000. Multiply by 2,295,000. Multiply by 365 what? Days. So your answer you get there is, when you work out that question correctly, the answer you get is 84.88 days. Then the last one, Roman 3, is about liquidity. Liquidity, in this case, there are two. We have been told calculate the current ratio and the quick ratio. So current ratio is given by current assets over current liabilities. So we can have 2024 here, and we can have 2025 there for that matter. So current assets for 2024, we have been given there 909,000. Divide by current liabilities class, I can see 675,000. No, not 675, but 450,000. So when you work out there, you get 1.44. Correct? Then for 2020, not 1.44, but 2.02 correctly. Then when you go to 2025, the same 2024, 2025, I can see 972,000. Divide by 675. This is 2025. This is 2025. Let me analyze current assets for both years first. So this one, then current assets for 2024, current assets for 2025. 2025 here. Current assets for 2025, quick. I want to see current assets for 2020, current assets 2024, current assets 2025. So for this case, it will be 972,000 divided by 675,000. So you get 1.44. Then when you come to current, we have now quick asset, quick ratio. We also call what? Test, quick ratio, or what? Asset test, which is now current assets minus any inventory. Inventory divide by current liability. Why are we subtracting inventory? Inventory here means that it will not be a quick cash. If you need cash, it is not quick, because inventory you need to look for the customer. So no one, you have not found anybody to buy this particular stock that you have. Therefore, it will take you time to look for the customer. Then from there, customer will ask you to sell on credit. Then it will take that period again to collect that cash. So it will take a lot of time to convert this inventory into what? Quick cash. So therefore, we subtract it. So the way we have just done here, we just need to say, for the first case here, we just take 909,000 like that, then minus inventory for that year. Inventory for that year is 360,000. Minus 360,000, you divide by 450,000. So your answer you get there is 1.22. Then for the other year 2024, for the other year 2025, it will be 972,000. You minus the inventory there, which is included there is 337,500. You divide by 675,000. So your answer you get there is 0.95. So that is how you are supposed to calculate that particular question. Good. We go to question. So I've done question 3, so I go to question 2. I go to question 2 class. So question 2 is about the management of cash. Management of cash. We say that in management of cash we have two methods. Method 1 is what you call what? Baumol. Baumol's method, which is a continuation of E or Q. Number 2, we can calculate this one using model Miller and O. So Miller and O accommodate stochastic or a probability, whereby we have now the upper limit, optimal, and also we have the lower limit. So in this question, we have been given lower limit, upper limit, and all that. So therefore it is Miller and O. So let's see question 2, Miller and O. Miller and O. So question 2. So Miller and O, question 2. It says, question 2b, calculate Roman 1 upper limit, which is head, which we normally say you take what? 3z minus 2l. 3z minus 2l. So L is the lower limit already given, but Z is missing. So we calculate Z. Z is calculated as 3bs square over 4I cube root of, get the cube root, plus L. Class, this first part here is, this what B stands for the transaction per transaction. S stands for variance, not the standard deviation. This variance here should be daily, per day. If the question gives you per month, you have to convert per month into per day. If the question gives you per year, you convert the year per year into per day, because this standard deviation is per year, that variation is per year. Then interest here should also be daily. Should also be daily here. So I is daily, S daily. This one will be given. Now from this question, we have already been given, so 3 times standard transaction per transaction, you have been told is 150 per transaction, times the variance. So we have been given the standard deviation of 200,000. How do you convert standard deviation into variance? You square it, right? Then you divide everything by 4 times, you have been given the rate there of 14% is per year. So you convert the 14% per year, which is now 0.14, divide, this is per year now, you divide by 365 days. You get that, class? Once you do that, you get the cube root there, then you say plus 500,000. So let me simplify this case. If you work out this question correctly, the answer you are supposed to get for the very first part, and class, what is this? What is that? It is called spread. So if you continue with your revision, you will find some questions asking you calculate the spread. Spread is now this first part of the Z. And therefore spread is given. How do you calculate spread? This is the formula. Or you say upper limit minus the lower limit. Upper limit minus the lower limit, you get automatically the spread. So this is your spread here. So if you calculate your spread using your calculator very well, the answer you get is 227,934 plus 500,000. So your answer there is 727,934. Okay, 934. 934. Now from there, you can now substitute your h. So your h now is 3 into 727,934 minus 2 into 500 what? 1,000. So your answer is 1,183,802. So you have your h. Roman 2. So Roman 2 is saying calculate what? Calculate the cash average. Calculate the average cash balance. So average cash balance is given by 4z minus L over 3. Okay, then you substitute now. This gives you 4 into z. Z we have already calculated z, and we have found to be this one. So 727,934 minus 500,000. You divide everything by 3. So your final answer, when you work out that question, you get 802,969. Then the last one, which is the third one, is calculate what? Return point. Return point. Remember, return point is also called the optimal, or you can call it what? Target. Examiner is very tricky. You'll be asked to calculate all this, and this one is also the same as z. In this case, we have already calculated z, which was, z was how much? 727,934. So class, be very careful with the terms here. So we go to C. We go to C. To C. So we go to 2C. C here. So C is also very simple. You have been asked that you have won the prize. You went for the competition and you have won. Assume that you have just won a competition prize with the following options. So we have been given the options, then you have been asked, assume required rate of return of 8%. Advise on the payment option that you would select. Which one will you select from option 1 to D? So let's calculate this. So we have option 1. We have option 1, which we are calling it A. For this A, you have been told a lump sum payment of 25.8 million in 5 years. So which means you wait for 5 years for you to receive 25.8 million. So therefore, it means you will receive 25.8 million at the end of year 5. So therefore, we need to discount that into present value. So therefore, we now take 25.8 times present value interest factor at the rate of 8%, 5 years. So this gives me what? 25.8 times 0. This one here is not annuity, correct? So this one gives you how much? That is 0. So if you press this your calculator, it will give you that figure. Then you multiply by this. The answer you get there is 17.559 million. I've said this one is 1 plus r power negative n. Correct? Then you go to option B. Option B. Option B, you have been told you are supposed to receive 16 million as follows. 16 million as follows. 5 million payable today. So we have option 1 today. You are receiving 5 million now. Then the second one, you are supposed to receive 5.5 payable after 1 year. So which means we discount this one to the year, which is 1.08 power negative 1. Correct? Then the second option is 5.5 the second year times 1.08 power negative 2. You press this one, then you multiply directly, you get the answers. So when you press that correctly, you get 5 point. Here will give you 5.09 million. Then this one is 4.72 million. Add, you get 14.81 million. So it means option 2, if you now paid today 5 million, then the rest will be paid now after 1 year and 2 years, you get 14.81 million. Then option C, you have just been told for the option C is that you have annual payment of 4.1 million for 30 years. Which means every year for 30 years. That is now annuity. Therefore, it's now present value interest factor rate of annuity at the rate of what? 8%, 30 years. Remember, look at how I've introduced A. If it is annuity, you do it like that. Then you multiply by 1.4. I've already given you the formula here. Or a check from the timetable directly. You get now, the answer you get here is 11. The answer you get there is 15.76 million. And then option D, you have been told perpetuity. So we have perpetuity, which is now we say amount over R, which is amount you are being paid there is 1.38 divided by R, which is 0.08. So when you press your calculator there, your answer you get is 17.25 million. Now, out of all the four options, which gives you the highest returns? Option 1. So select this. So advice is select that one. Then you go to the last question, that is question 1. The last question is question 1 class. So things are very easy. Financial management is not hard. It's just a matter of ensuring that you have understood your lecturer well and ensure that you have also prepared and read and do as many questions as possible so that you are able to get the questions right. Now we go to question 1. Question 1B. Question 1B is about marginal cost, or sorry, not marginal, but weighted average cost of capital, which is given by weight of equity, cost of equity plus weight of preference, cost of preference plus weight of debt, then cost of debt. Once you have written your formula like that, weight you need to calculate using the market value. Cost of equity you need to calculate using now the current capital structure. Then you substitute all that. So let me calculate the cost of each source. Now, cost of equity here. Cost of equity is given by D0 into 1 plus G over P0 minus F plus G. From this question, we have not been given anything to do with the G. So we need to do some computation here. You have been told the market price of the dividend is 44 shillings cum dividend. So when they say cum dividend, it is inclusive the dividends inside. And because you want the correct market price of the shares here, we have to remove the dividends. Remove the dividend from the total so that you get the accurate market price. So in this case now, we can say P0 here, P0 is equal to 44 minus 40, which minus 4 will give you what? 40. So the correct market price is 40 shillings, not 44. You get that, class? Now again, we have again been told, when you go to additional information number 1, it says the existing 14% debentures are currently selling at 124 cum interest. Cum interest means that this is not the correct interest. This is not the correct market price of that particular debenture because it has interest inside. So we need to remove the interest. So let's calculate that also and remove the interest. I think when we reach there, we shall do that. So this gives me what now, class? What is the D0? Another problem that is in this question is that we don't have G. So we need to calculate our G. So our G here will be given as dn over d0 get the root of n. So dn is the dividends, the current dividends. Not the dividend, but the dividends after year n. So which means in this question it is 2024. Then d0 is the current dividend, which is 2019. Now, when you say n, it will be for 6 years, yes, but we don't include the current year. So we will use 5 years. So therefore, in this case, it will be 4 divided by 3, then root of 5. Then you minus n, minus 1. So 4 divided by 3, root of 5 minus 1. So when you do that correctly, the answer you get will be, the answer for that G, the answer for that G will be, the answer for that G, the answer for that G will be 5.9, which is the same as 6%. So because you have now everything, so substitute in your formula now. KE is now D, which is 4 into 1 plus 0.06. Then you divide by market value. We have now 40. Do we have any flotation, class? No. So we don't have any flotation. Then plus 0.06. So when you work out that, class, the answer you get is cost of equity is 16.6, which I can make it to be 17%. Then you go to cost of preference. Cost of preference is given by DPS over market value, P0 minus F. I'm bringing F because that is the flotation cost, which is going to affect our part C. Now, in this case, now, DPS is what you have been, go to the preference. The preference you have been told it is, preference you have been told is 10%. You always say 10% of the par value or the face value. Don't say 10% of the market price. It is 10% of the par value. So it will be 10% of market price are there is how much? Not market price, but par value of 30. Divided by the market price of 20, which is 3 over 20, gives you 12%. Then we go to cost of debt. Cost of debt in this case is int into brackets 1 minus t over value of debt minus floated if there is any flotation. So again, market value, there is a problem here. There is no flotation, yes, but the market value of the debenture has the interest. We need to remove interest. So therefore, VD is now 124 minus, what is the interest of the debenture, class? It is 14%. So 14% of 100. Remember, debentures are always paid twice in a year. And because it is paid twice in a year, we need to capture that principle here. So this 14 is for the whole year. So half a year, 7. So you can now multiply by 1 over 2. So this gives you 127. 124 minus 7 gives you 170. So this is our market price. So therefore, in this case, it will be now interest is how much? 14. Interest is 14. Interest is 14 into 1 minus 0.3 divided by market value, which is now 117. So what is your answer? So the cost of debt for that particular, it gives you 8.4%. 8.4%. So that is how to calculate that. So have we calculated all? Yes. Now what is missing is the market value. So let's calculate the market values now. The reason why we are calculating the market value is to get the weights. We're now to calculate these weights here. So we now say, okay, what about ordinary share capital? Market price of the ordinary shares, 40 shillings. So how many ordinary shares are there? So we go to the current capital structure. Current capital structure we have been given for this case is 20 shillings per value. Then it will be 60 is equals to 60,000. Each ordinary share is 20. Market price is 40. Now, if reserves or retained earnings are a part of the ordinary shares, right? They are a part of the ordinary shares, so you cannot separate that from here. So we need to add the retained earnings of 20,000 or reserves of 20,000. So when you work out this one, your answer is 140,000. Reserves are always added to the ordinary shares when you are calculating the market price. Then we go to the market price of debentures. What is the value of debentures class given? 30,000. How much per debenture? The par value given there? 100. How much is the market price of the debenture class? 117. So what is the value there class if you multiply? So if you multiply that, you will get 35,100. Then we go to preference shares class. So how many preference shares are there class? The value of preference shares given 20,000. Correct? How much is the market? How much is the par value? 30. How much is the market price? 25. So when you press your calculator, you get your 16,667. Market price class 191,767. So out of this now, you see I have now the total market value. If I want now to calculate the weights, that is WE, WP and WD, I will start. WE is 140 divided by 190, 191, 761, multiplied by the cost of equity, of which I have already calculated to be 17, plus weight of P, which is 35,100 divided by 191, 761 times cost of preference, which I have calculated to be 12, plus weight of D, which is 16,676 divided by 191,761 times the cost of debenture, which is 8.1, then you get the answer straight. So when you substitute now what I've done here in this equation here, the answer you are supposed to get for that case, the answer you are supposed to get for that case is 14.92%. 14.92%. Class, I've used the market value here. When you go to our notes, we say you can calculate the weights here by use of the market value or book value. So I've used the market value. So if the question given has market values, that is the price per share in the market at the moment, then it is like you are being directed to use the market what? Value. But if this information is not there, class, you can still use also the book value, which means the capital structure as it is at the moment. Good. So we move on. Okay. So I go to the last one. That is C. C is asking you to calculate the weighted marginal cost of capital. I want just to explain that. Marginal cost of capital. So you have been told to calculate C, weighted marginal cost of capital. It is the same as weighted average cost of capital. The only difference here is the word marginal means additional capital. So therefore, if you raise additional capital, if you raise your additional capital from various sources, it means that you are also increasing the cost. So you want to calculate how much is this average cost of capital that we have actually raised from here. So therefore, that additional cost of capital is what you call marginal cost of capital. The one you have just calculated, that is weighted average cost of capital, is the overall cost of capital as we speak. But if you want to raise any additional capital, you will incur additional cost. And that additional cost is what you call what? Weighted marginal cost of capital. That is why the question is also the one that will direct you. For example, the question is saying, suppose the company in B, the one that we have just worked out above, wants to raise additional 50 million to finance an expansion program as follows. So in this case, we have already been told they want to raise additional 50 million. So therefore, the first part is retained earnings. Retained earnings of 30% of 50 million will give me what? 15 million. Then they are also again saying there is ordinary shares, ordinary share capital, again 30% of 50 million will give me what? 15 million again. Then they are saying there is a debentures here. They are changing debentures, which will take now for, this is what you see from this question, already weights from the first question you are calculating our weights by use of market value. But in this one now, weights have already been given. So we have already the weight. So our work will be only to calculate the cost of capital for each source. But the weights already have been calculated. So ours will be very easy. So this one is 20 million, sorry. This will give you 50 million. So they want now to raise this. Class, there is now, I said that retained earnings or reserves will be part of the ordinary shares. It is part of the ordinary shares if the flotation cost is not given. But if the flotation cost is given, it will be the cost of retained earnings will be calculated differently from the cost of ordinary shares. The formula will be the same. The only difference is the flotation cost. So let's see. For the cost of retained earnings R here will be D0 into 1 plus G over P0 plus G. We are not saying minus flotation here because this amount retained earnings is what you have already. So you will not incur any cost. Therefore, it means from this additional information I've just said 30% from the retained earnings. So where will you get the figures? The figures will come from B. They have told go back to B. So therefore, our correct cost of equity will remain as 17%. Because if you try to substitute, it will just give you 17. But when it comes to cost of equity, that is the ordinary now shares, it will be different because you have been told is D into 1 plus G over P, the market value you have been told here is 40 shillings, minus they are saying flotation cost of 2%. 2% of 40. So you say now 2% of 40. 2% is the flotation cost. 2% is the flotation cost. Then now say, again you have been told there is another discount. So people are negotiating. Kindly reduce for us this price from here to about 3 shillings per share. So they are again substituting that. So when you work out this question, up here was 4 plus 4 shillings into 4 shillings. 4 into growth of 1.06. You remember it was like that, over 40 minus this one here. So if you work out this one correctly, this it will give you 36.2. 36.2 plus 0.06. 0.06. So when you work out that question correctly, the answer you get is 17.7, which can be around 18%. Nobody will penalize you on that. Then cost of debt, still yield into 1 minus T over value of debt minus any flotation. From this C we have now the flotation cost. So it was 14, you got 14 shillings. Remember it was 14. Now in this case it is 12, sorry. 12%. 12% of 100 for debentures. That's what they are saying. For 40%, then 12% debentures. So irredeemable. So in this case, they are saying they are now using the 12% irredeemable. So in this case, it is 12% of how much was the par value? Par value is 100. Correct? Then you pay now the dividends. Tax, sorry, like that. You divide by the market value of 100, but there is a flotation of 10. So if you work out this, it will give you 12 into 0.7, like that, you divide by 100. So the answer you get there is 8.4%. You can see. So I have now everything. So my work now will be very simple. How do you calculate this one? Is now cost of retained earnings times cost of retained earnings times weight of retained earnings plus cost of equity, weight of equity plus cost of debt, weight of debt. So do I have? Yes. Cost of retained earnings 17 times its weight, sorry, weight is 30% plus cost of equity 18 times its weight 30% plus cost of debt 8.4 times its cost of equity, cost of debt is 8.4 times its weight 40%. So if you substitute now in this one, the answer you get is what you call weighted marginal cost of capital, which will be equivalent to, which will be now equivalent to 13 point. So the answer you get here will be, sorry, the answer you get here will be 13.86. 13.86 what? Percent. Then the last question was saying calculate what? The last part of that is compute the number of ordinary shares to be issued to raise the desired external equity capital. So you go back to the equity. Where is equity class? Equity is here. So how many shares can we raise from collecting 15 million? How many shares are here? Now the question is very simple. How much is the market price? So the market price we found for the equity is 36.2. So we now say I'm out of this. So one ordinary share capital, the market price is 36.2 shillings. What about 15 million? Will give me how many ordinary shares? So it will be 15 million divided by 36.2 times 1 ordinary share capital. So your answer is 414,365 shares. You can see. So this past paper was very easy. Especially for those students who prepared very well for the August 2025 past paper for the exam. So therefore we have another exam that is coming on in December 2025. Kindly, I wish you well as you prepare for this particular unit. If you have any challenge, can reach me on 0735 346 777 on WhatsApp or a call directly. I'll be able to assist on what I have actually done. Secondly, if you have not subscribed, kindly I request you to do the same. Subscribe, share, and invite as many friends as possible. Thirdly, I request if you want to support this particular free lessons, kindly reach out, send any financial support on 0735 346 777. It will just be Simon Makan, and will be able to support this particular area. You can see I'm struggling to get the equipment that is very clear. So I have a challenge. So kindly support me so that I'm able to get the equipment for broadcasting and also be able to reach you on time, and also to have internet for the purpose of projecting this, because I have also to prepare financial reporting. I have also to prepare advanced financial management. But because of the challenges I'm facing on to get the equipment, so I'm struggling to get. So kindly you can also assist me on that, and God bless you.